Today is part 3 of the Securities Lending Indemnification video series. I'm going to answer whether they are like emergency services in a crisis, or are they an unnecessary waste of resources, adding costs with little value. If securities lending is your thing, if you're a lender, a borrower, an intermediary, a vendor, an advisor, or just plain interested, then this is the place for you. So let's get started. Hello everyone, I'm Zimmerhansl and welcome to another episode in the fundamentals of securities lending. Today is the third in a series focusing specifically on securities lending indemnifications. The inspiration for this video series was a recent paper from Mark Faulkner, the co-founder of Credit Benchmark, entitled Something Better Change. Securities lending indemnifications is unsustainable in its current form. There's a link to Mark's paper in the description for this episode, and I encourage you to read it. In the first video, I gave an explanation of what indemnities are, what they do and don't cover, who's covered by them, and how agents pay for or provide indemnities to their lending clients. Then in the second video, I explained why we should care about indemnities, provided a little bit of a sense of the size and scale of the business, took viewers through the waterfall of protections before an indemnity would even take effect. I gave some examples of firms that were in securities lending that went bust or were rescued, and then I gave 3 default scenarios to show how much of a shift it would take in a market for an indemnity to kick in. So if you want a comprehensive view on indemnities, I suggest you go to the playlist that I'm showing on screen now. This is one of the 3 videos in that playlist. If you're looking for a wider grounding on securities lending risks, including indemnities, you can instead go to this playlist, which includes the indemnity videos, as I say, but also has other videos providing a wider view on securities lending risks. Today, I'm going to wrap up the series by looking at Mark's conclusions and then add my own thoughts on where things go from here. I'm going to be addressing the 9 key points from Mark's paper, and hang on to the end where I share my own views on the future of indemnifications. Before I get started with the review of his conclusions, if you find this video and others helpful, then please give it a thumbs up. And if you are interested in securities lending and haven't subscribed yet, maybe you should do that now. And if you want to be advised about every time I post a new video, make sure to ring that bell so you can be notified. Now, on to the conclusions. Look, there's no question that the return on capital deployed has become a major issue at all banks. Mark correctly points to securities lending as being just another business that banks do, and that like other banking businesses, they have to compete for investment and capital. If indemnifications are going to continue to be reliant on attracting more capital in order to support growth, that's going to be a big challenge. And without change in the cost and volume dynamics, it seems inevitable that agent bank lending businesses will face a decline over time. Mark is correct that general collateral consumes capital and produces low returns, but I'm not sure that I agree that it's unrealistically priced. Remember that securities lending pricing is based on supply and demand. It's about as basic as economic gets. If there's an excess supply in a stock, then the price over the demand for that stock, then of course the price will be low. The issue that I see is that the profitability of supporting general collateral is too low, and maybe that's what Mark means. We can changing profitability, you can increase revenues, you can decrease costs, or a combination of the two. So possible solutions to the dilemma? Well, number one, as interest rates rise, there's an opportunity for investors to generate higher returns through the reinvestment of cash collateral. Now, of course, that requires the acceptance of cash collateral, brings with it additional risk. And remember that reinvestments aren't typically covered by indemnities, yet are the largest source of securities lending losses. And it's really only available for US dollar cash at the moment, as Euro has only just moved into positive interest rate territory, and other currencies don't have the depth or breadth of investment opportunities. Number two, I cover it in other videos, but the real operational cost for securities lending isn't on the trade execution side. It rests with the post-trade daily administration of the loan. If you reduce the cost of post-trade, then you increase the profitability of general collateral trades in particular. And of course, the best way to make GC trades more profitable is to remove or reduce the cost of the indemnification. I can't tell you how long people have been talking about consolidation in the custody industry. And of course, they're right. There has been consolidation over time. But custody is a great business. Once you have clients, it's a pretty big deal for those clients to actually shift their business elsewhere. It is very sticky annuity business. And in order for you to lose a client, you either have to do a terrible job for an extended period of time without improvement, or there is a wider strategic decision that the investor is making and custody is part of that. Or maybe a competitor is offering such a huge discount that the time, effort, and execution risk of a transition to a new custodian is worth it for that client. Cross-subsidization has been declining for some time, and European regulators have had it in their crosshairs for several years, reducing the impact of these sorts of conditions. Nevertheless, I don't really see any large-scale departures in the near future. Firms that have exited the business have largely been niche or second-tier providers. The largest transaction in recent history is the acquisition by State Street of the Brown Brothers Harriman Investor Services businesses. And with over $5 trillion in assets under custody, it seems odd to call the business small. But when you consider that at the time of the announcement, State Street had over $31 trillion under custody. So you get a sense of the scale of the top tier providers. In other words, I don't really see this as a transformational change to the economics of the business. I think that to a degree this goes alongside the cross-subsidization point earlier. Investors understand that each component of their activity has value and that they need to find a way to extract that value, whether that's insourcing or outsourcing or combining multiple service providers rather than the traditional model of a single one-stop service provider. I think that particularly the top end of investors have become much more sophisticated and discriminating in their service provider selection and management. I think this is an interesting suggestion. As Mark has been a business disruptor through much of his career, when he says something like this, you need to pay attention. Despite the challenges of breaking into a new business activity, disruptors have one major advantage over incumbent service providers: they don't have a legacy business to protect. So no concerns over challenging past decisions made by executives that are still in control or maybe even been promoted to more powerful positions. They have the benefit of seeing what has and hasn't worked for existing service providers, avoiding the mistakes and improving on existing models and practices. They also can implement the product with the latest technology without having to support legacy systems that may no longer be fit for purpose. Don't underestimate the challenge. No track record and the fact that people are penalized for making decisions that don't work out but aren't rewarded for challenging the status quo and driving change and innovation. Nevertheless, I think Mark is spot on this point. I have been saying for years now that I don't care who drives progress in the securities lending business, but progress is a must. Now, insurance companies play a niche role in the indemnification space, and Mark suggests that they could play a much larger role. Now, I agree wholeheartedly, and here, look, for full disclosure, I'm involved with that expansion at this very moment. If you'd like to learn more, reach out to me and I'd be happy to discuss it with you. Mark's paper identifies that risk transfer is a fundamental part of what banks do, and here he questions whether that through making indemnities capital intensive, they are challenging banks towards shifting the risk elsewhere. Now look, I have no special insights into what regulators think, but my guess is that's partly true. Regulators want capital to be expensive in order that banks take a prudent approach to how they deploy capital. Now, Mark makes the point that throughout the paper, in several places, that the current cost of capital for indemnification does not reflect the true economic risk of the support that banks are actually providing. Now, be that as it may, for the moment, it is what it is. So, if it acts as a cap on business for banks or directs them to find other solutions, then yes, I think there's a reasonable case to be made for purposeful redirection by regulators. However, I also think that regulators know that directly or indirectly that they will end up being dragged into the discussion if in future there's going to be some catastrophe where indemnifications could have protected investors but were no longer offered by banks or only selectively offered for specific transactions or specific customers. Imagine a small pension fund loses money in securities lending and no longer had an indemnity because they didn't have the economic clout with an agent lender that a big pension fund did. How's a regulator going to explain that indemnities used to be commonplace, but to make banks safer, they expose small pension funds to more risk? Of course, end users of borrowed securities want to get access to more securities and at a lower price. Their access points are the securities lending intermediaries, and while they could drive or co-lead innovation, there is a risk, as Mark points out. After all, they would remain dependent on the widest community for access to the full range of securities that they want. So freeing up a portion to be borrowed in a different way, while it might be helpful, it would take time, if it was even possible, to make a large-scale, impactful change. I think this is pretty straightforward. Investor A invests directly in hedge fund X, but won't lend securities to it without an intermediary being involved and an indemnity. Now, look, when an investor invests directly in a hedge fund, their return expectations for that exposure relate to an investment level return. But if that investor was going to lend securities to the hedge fund, it would get some or maybe even most of the intermediary fees, but take on the risk of an opaque entity, probably without the information skills or technology to monitor the day-to-day risk. In summary, I think that aside from a couple of minor points, I think Mark has done an excellent job at assessing the issues and challenges and likely outcomes for indemnifications. Okay, so those are my thoughts on Mark's conclusions, but what about my own view on the likely future direction? Let me first say that I don't think that the majority of investors that already get indemnifications are going to give them up without a fight. I think the objective here will be kind of a renegotiation of a fee split, which I see is more likely. Now, don't get me wrong, I don't think that investors will be happy to give up revenue, but I've been through this in discussions with clients before regarding the returns on risk-weighted assets. So I know you can have these difficult conversations. If you approach it logically and fact-based, it seems to me that most clients would rather take a small hit in returns and keep the protection an indemnity provides even where they don't believe it's likely to be used. The argument is that no other insurance coverage they get is free, and as the indemnity is really akin to an insurance protection, it has to carry a cost, and that should impact the fee split. Now, there will be customers that will agree to forego an indemnity for some or all of their lending activity, but again, that's going to shift the discussion in a different direction. If the agent is arguing that the cost of capital is prohibitive and the client relieves them of that cost, that client will want compensation for taking back the risk. The overriding issue, though, is the cost, and there are two aspects to this. As Mark argues, more regulatory lobbying is required in order that the amount of capital required becomes a more realistic reflection of the economic risk that service providers assume. The second aspect, though, is that I expect agent bank lenders will move to a hybrid structure of indemnification, including some supported also by a degree of insurance and other risk transfer components. It's the only way that I think the business can continue to support the existing client business and position themselves to be able to grow cost effectively in the future. Now, those are my views, but what about you? What do you think the future holds for indemnifications? Please share your views in the comments. I'm really interested to hear what you have to say. To sum up, Mark wrote that something better change. I think he's right to point it out. I think that some things are already changing very slowly. I think that those changes will continue, and that change will accelerate over what seems sometimes to be glacial progress. So that's it for me for another video. I hope you found this useful and informative. I'm Roy Zimmerhansl, your host for the fundamentals of securities lending. Have a great weekend, have a great week, and I look forward to catching you next time.